My name is Chuck Whitman, and I build great traders that lead great lives. Traders I have trained have generated in excess of $1 billion in trading revenue and are found at some of the top proprietary trading firms and hedge funds in the United States. So, how to trade FOMC. Tomorrow we have the FOMC meeting, and this is one of the most anticipated events in a very long time. The last time the Federal Reserve made an interest rate decision was in July of 2023 when they made their last interest rate raise. So they've been on the sidelines in terms of changing interest rates now for 14 months. And the market has been eagerly waiting, eagerly anticipating this moment when the Federal Reserve would begin to cut rates again. Because the market has believed that when the Fed starts to cut, it's going to be bullish for stocks again. So let's look at how we trade FOMC. When we look at trading FOMC, I break it into 3 different time frames. The 3 separate trading periods are pre-FOMC, which is starting today, Tuesday, through tomorrow, Wednesday at 1 p.m. Central Time when the statement comes out. So it's how do we trade today and tomorrow pre-announcement. The second period is when the announcement comes out, when the rate cut announcement, the statement, and the dot plot come out tomorrow at 1 p.m. Central Time. So how do we trade off of that information? And that creates a second time period window between 1 p.m. and 1:30 p.m. Central Time. Then lastly, we have for after 1:30 p.m. Central Time, which at 1:30 is when the Federal Reserve, when the Fed starts their press conference. This is when Chairman Powell gives his prepared statement and then opens to the press to answer questions. Each of these has a different mindset of how to think about trading them, and I want to go over that with you today. First of all, pre-FOMC. Well, in pre-FOMC, the price action on Tuesday and Wednesday tends to be bullish, sometimes very bullish. And the price action during this period tends to be one in which the market drifts higher. It just steadily goes higher, 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 higher. Very few pullbacks, no explosive moves, just goes higher. Particularly on Tuesday. Wednesday as well, but Tuesday is the big period that you see this behavior. Now I have a theory about this, and my theory is that I believe the Federal Reserve manipulates the stock index futures market. And by doing so, it manipulates the entire stock market. This could be a whole nother video, but I'm going to explain it briefly. And that is when you buy a stock index future, it settles to cash. All other futures contracts tend to be physically settled. So if you buy a contract of corn, well, as you near expiration, you need to sell out your corn or you are going to have to take delivery. You're going to physically have to take corn. And this is important because as you go to expiration, every long must get out. So the market really looks at the positioning of different participants. And if the market knows you're a big long and you must sell ahead of expiration, then they'll tend to race you as you're trying to get out. When they designed the S&P futures contract, they did it very differently. They actually did it to try and avoid manipulation, which ironically opened it up to be manipulated. And why is this? With the S&P futures contract, it was very difficult to be able to receive 500 stocks at the proper ratio. So what they did is they made it a cash settled contract. That means if you buy an S&P futures contract, you never have to sell it if you don't want to. You can take it to expiration and they have what's called the print. In the print determines how much money you get back. So on the print, if you're long a futures contract, well, you're going to have a settlement price and then you're going to have a defined profit or loss and have a return of your margin. It's very simple, so you never have to get out. This is why I believe the Federal Reserve uses it to manipulate, because essentially they can come in and buy futures contracts and they never have to sell them. They don't have to worry about getting raced out. They never have to sell them. They just let them expire. And they do it again. And when you start looking at the Fed with an $8 trillion balance sheet, buying 10, 20, $40 billion of S&P is a rounding error. So it's easy for them to do. So I believe they do this to stabilize the market, and I believe they do this to window dress the market in specific time frames. like FOMC. So the Federal Reserve wants to make sure that going into FOMC, one, that the market is stable, and two, that there's a slight bullish tone to it, which is going to make people feel good. So one of the things that I believe is I believe on Tuesdays and Wednesdays that they are a steady bid in the market. Buying it below, buying it at, never in a hurry, buying just enough to just put it up. So again, there's a lot more I can talk about with this, but if you go through and you'll look, you'll see that Tuesdays pre-FOMC tend to be quite bullish. And this is what I call an environmental indicator. So listen to what I say here. Just because it's bullish on Tuesdays does not mean you should run out and buy it Tuesday on the open. We have what we call environmental indicators, and we have tactical indicators. An environmental indicator is something like, well, the market goes up on Tuesdays before FOMC 78% of the time. Great. That doesn't mean you should buy it. That means that you could take your strategies and be hypersensitive that longs could work really well on Tuesdays, but trade your strategy long in the context of that. Don't just buy it. Okay? So the strategy is Tuesday, Wednesday. If you are trading stock indexes or SPY, that if you would be on the lookout for intraday longs that you could hold for a few hours or all the way to FOMC. Okay, now the second period is when the statement comes out. At 1 p.m. Central Time, the prepared statement is released, the interest rate decision is released, and the forward interest rate projections, which is just known as the dot plot, is released. That all comes out at once. Now tomorrow, the focus is really going to be on the interest rate decision. The market believes there's a 100% chance that interest rates are going to be cut tomorrow. The question is by how much? Usually when you go into meetings like this, there's a lot of consensus that the Fed's going to cut by 25 basis points or they're going to cut by 50 basis points. But tomorrow it's quite mixed. In fact, there's a 63% chance that the Federal Reserve is going to cut by 50 basis points, and there's a 37% chance that they're going to cut by 25 basis points. How do we know this? Well, there's a tradable contract called the Fed Funds Futures Contract that's traded at the Chicago Board of Trade CME. And so essentially, that is the free market trading what they think the Fed is going to do. And that's how you can see this projection. Now, I could do a whole video on this, and I'm not going to, but there is a tool that's really helpful that you can go to the CME website, and you'll see the link here in the supporting PowerPoint. You'll see you can go to this link, and it's called the Fed Watch tool. And this Fed Watch tool, you can see by the graph that there's a 63% chance that interest rates will be between 4.75% and 5%, and a 37% chance that they'll be between 5 and 5.25%. Well, right now, interest rates are set at a range of 5.25 to 5.5, with the median being 5.33%. So you can see a 37% probability of a 25 basis point cut and a 63% probability of a 50 basis point cut. And that's all right there in the tool. So anytime you go into a Fed meeting, you can just periodically look at this tool, and you can see not only for the next meeting, but you can see into the future, in the next few years, what the market thinks interest rates are going to be versus what the Fed thinks it's going to be. So it's a very helpful tool. So there's also going to be a lot of attention put on the dot plot projections, because do they expect further 50 basis point cuts? Do they expect there to be continuous 25 basis point cuts? How far out do they expect this to go? And you can see all of that in the dot plot. What the dot plot does is it shows the interest rate projections of the future meetings and then into future years for each of the 19 Fed officials that contribute to the Fed. There's 12 governors and 7 Fed officials. That makes up the 19 officials. They all vote, they all contribute to the dot plot. And so on the dot plot, you'll see 19 dots representing what each of them think, and you can see how unified they are or how much in disagreement they are, both in what the rate should be in any given period and in the path over time. Now, again, I've included a link for you that's at Fidelity. That Fidelity does a great job going into all the nuances around the dot plot, so you can check it for yourself. But you can see in the graphs I provided, there's a great graph here that basically explains the Fed funds rate and the time and what each of the dots represents. So you can check that out. And then in June, this was the dot plot And essentially, there's a belief that by 2026, the Fed will cut to 3%. That'd be a 2.25% cut from where we are now into 2026. So let's talk about how to think about trading this. Well, traditionally, the Fed cuts interest rates by 50 basis points when they do the first cut. Now, usually they start cutting because the economy is falling apart. They start cutting because there's been some kind of financial shock. They cut because we're in recession. We don't have that right now, and that's one of the things that makes this very interesting. Are they going to cut that big, even though things aren't bad? So if it does, what kind of message is that sending? Is it sending that they're actually more worried about what's going on than they're leading on to? Is it sending a message that they're really trying to stimulate the stock market and the economy ahead of the election? I don't know. But it would be very abnormal, but that's what the market in general thinks they're going to do, which is very interesting. So I would view this that if the Fed does cut by 50 basis points, I would view this to be a major catalyst for the market. If it cuts by 25 basis points, then I think the focus goes to the dot plot and the press conference. I think 25 basis points would be viewed as somewhat disappointing, somewat negative, which we'll cover here in the scenarios, but that could be made up by the dot plot projections and by things that Powell says, so we don't know for sure. So how we trade this? I think if the Fed cuts 50 basis points, I would expect the dollar to sell off. I would expect gold to rally hard. Gold has had a strong breakout. Gold is one of our favorite themes. It's been strong all year. Maybe recently not as strong as I thought it should be, but it had a major breakout up in the last week. And I believe if they cut 50 basis points, I think gold could take off. That would be my most bullish idea. I think stocks will rally, and I think this could kick off a multi-week, multi-month strong rally in stocks if that does happen. I think fixed income rallies. Fixed income has been also flirting with and breaking out, especially on the shorter end of the curve recently. So showing signs that fixed income really wants to rally, which is a reflection of lower interest rates. So that's what I would see happening if they cut 50 basis points. I would have these scenarios I just described. I'd have them all mapped out, and I'd be locked in on a handful of products. For me, I would be locked in on gold. I'd be locked in on S&P, and I would be locked in on the 2-year and 5-year note. That's where I would focus. That's where I will focus. Okay, now, if the Fed cuts 25 basis points, I would see the dollar bounce because I think it'd be mildly disappointing. I would see stocks sell off, at least initially. I would see fixed income sell off. I would see gold more stabilized to sell off, although the gold positioning is actually somewhat bearish. In this case, though, I believe rather than have some big catalyst response like, oh my gosh, I think they would switch the attention to the dot plot and the press conference. If the dot plot shows future cuts, future 50 basis point cuts, aggressive cutting in 2025, then I think that could be mitigated. Also, what Powell says could mitigate this. So I would be patient and I would actually go to the sideline. Okay, so let's go back to the 50 basis point cut. What I would do is I would bracket the high and low. Whatever the market does after 1 o'clock, I would look at it 5-minute and 15-minute windows, and I would look and see, is the market able to take out the high or low in those time windows? So I might set the first 15 minutes. So 1 o'clock, the announcement comes out. 1:15 p.m., I would start looking at the highs and lows. And let's say they cut 50 basis points and I'm bullish gold. Okay, I would be looking at what gold is doing after 5 minutes and what it's doing after 15 minutes. And if it starts taking out those highs, then I would start getting really bullish intraday. Same with stocks. If stock starts taking out the 5-minute highs and 15-minute highs on a 50 basis point cut, then intraday, I would start looking at getting long. If they take out the lows, that may lead me to be short because why is it breaking? More than likely, I'm only going to hunt the longs. I'm only going to hunt the bullish scenario off the 50 basis point cut, but I am open to seeing what the market tells me. If there's a 25 basis point cut, I'm going to go to the sideline and I'm going to wait. I'm going to let everything sort itself out with the press conference, and then I'll go back and look. So now that takes us to the third period, which is the press conference. So in the press conference, it'll start with Chairman Powell giving his prepared statement and then taking questions. We want to be really careful because oftentimes there are big head fakes in the market around this time window. Sometimes the market anticipates the statement one way, let's say really bullish, and then Powell starts talking and the market reverses hard. Sometimes the market's bullish, Chairman Powell says something, market breaks hard and then comes flying back. There can be a lot of volatility around the press conference. A lot of head fakes. So this is why we want to be patient. In that 1 to 130 window, the more convincing the catalyst, the more aggressive I would trade. But I'm always leery of the press conference. So I'm not going to go in massive size. I'm not going to go in full size. I'm going to put positions on at a smaller size. The more conviction I have, the bigger it'll be, but it won't be full size. And then I'm going to watch. I'm going to let it play out. I may even hedge. If I get a bunch of profits in my trade in the press conference, I may even hedge it. One thing to think about is after the announcement, volatility tends to go down. So by the time we get to the press conference, a fair amount of volatility has already been sucked out of the market. So it's actually cheaper to hedge at 130 than it would be at 1. Okay, now when the press conference comes out, I give it about 15 minutes. Usually all the fireworks either happen right away in the statement, which takes a couple minutes, or it happens in the handful of first questions. By 1:45 p.m. Central Time, I consider most of it to be done. So what I would do is I'd bracket the entire period between 1 and 1:45 p.m. Central Time, and then I would start watching these markets I talked about. 2-year note, 5-year note, gold, S&Ps. Those would be the ones of note. You could also really watch the yen. The yen is also potentially a big one. I would start watching for follow through out of that range. Now, in the range from 1 to 145, the bigger the range, the less likely we are to go anywhere after, at least for a while, because the market would have been too volatile. But if the range is not too big and we start to pop out with confirming volume, so if we pop out higher, we'd see buying coming in as we leave the range, and that's going to be a trade I'm very interested in. Off of that range, when we leave that range, that can oftentimes be a move that not only you could trade intraday, but if you got it on right, you could hold it for multiple days, multiple weeks, because it's a catalyst that shifts market perception, and sometimes that follows through for a long period of time, which is an awesome trading opportunity. You might be able to enter today on Wednesday after FOMC. You might be able to enter on an intraday risk and get 2 weeks of range, which you'd have a home run trade. Let's recap. Pre-FOMC, we use Tuesday, Wednesday, knowing that's likely a bullish environment. So if we see our traditional bullish setups, we would like them better, more than normal because of the backdrop of pre-FOMC. Then we go to the statement, rate cut, dot plot, 1 p.m. We have the 1 to 130 window. In the 1 to 130 window, if they're aggressive in cutting, then we are going to pursue trades that benefit from rate cuts. If they're not aggressive cutting, then we are going to sit back and watch and be patient. That would take us to the press conference. Press conference at 1:30. We let Chairman Powell give his opening statement. We let him take questions. And at 1:45, we frame the entire period from 1 to 145. And that gives us our range. And then we watch really closely to see how do we break out of that range. If we're able to break out of the range with confirming volume, then that is going to be a move that we're interested in, knowing that it could last a few days to a few weeks to even a few months. So there's your mindset. There's your map for how to trade FOMC. Worked out great because this is Tuesday. And it's not just any Tuesday, it is Trader Tip Tuesday. And you know what Trader Tip Tuesday is. Trader Tip Tuesday is the day I bring elite tactical techniques, things that you will not see anywhere else, that will help you take your trading performance to an elite level. I'll see you next Tuesday.